On May 14th, the day the Clarity Act passed, Hyperliquid jumped 11% in a single day, outperforming Bitcoin, Ethereum, and nearly every major token. Why did the market react so strongly to this specific project?
That's exactly what we're unpacking today. Hyperliquid is essentially a perfect storm of every complex judgment call under the Clarity Act. This one project carries the toughest legal questions in the entire bill. Today, I'll use it as a case study to walk through the full decision tree. How it gets classified, who regulates it, what it needs to do over the next 12 months, and what its real fate looks like.
The Howey test and the SEC's March crypto classification statement. You covered those before, right?
Yes, won't repeat them today. Link in the description.
Let me throw out a question to start. What exactly about Hyperliquid needs to be regulated? It's a dYdX, a chain, a token. These things feel all tangled up.
Good question. Once you separate them, it's really just two layers. First, the Hype token itself. Second, the Hyperliquid L1 system. This chain is simultaneously the ledger, the matching engine, and the liquidation system. 3 roles, 1 entity.
Why split it into these 2 layers?
Because these 2 layers follow completely different paths under the Clarity Act, and the conclusions can be polar opposites. The token layer judgment determines whether Hype's secondary market trading counts as securities transactions, which directly affects whether compliant U.S. exchanges like Coinbase dare to list it, and when the team and early investors can unlock and sell. The system layer judgment determines whether Hyperliquid can even legally operate in the U.S. This is an existential question. The token layer may be a boon. The system layer may be a death sentence. 1 foot in heaven, 1 foot in hell. That's why Hyperliquid is the perfect test case for the Clarity Act.
All right, let's start with the token. But before we get to Hype, I have a question I never quite figured out. Clarity introduces 2 new terms, network token and ancillary asset. What's the relationship between them? Are they opposing binary choices?
Wrong. That's a common misconception. They're not opposing. They examine tokens from different dimensions. Network tokens look at, what does the token look like? Does it carry equity rights, debt rights, liquidation distribution rights, dividend rights, or profit-sharing rights? These are the financial rights that would inherently make something a security. The Act has a specific negative list. If a token doesn't carry these rights, and its value is intrinsically tied to a distributed ledger system, it can potentially qualify as a network token. Ancillary assets look at, where does the token's value come from? Is it driven by the operation and use of the network itself, or by the efforts of some originator or related team? The Act's exact phrase is entrepreneurial or managerial efforts. If the value still depends on the team, then it's an ancillary asset. Note that these are 2 completely independent judgments. A token can satisfy both, only one or neither.
Give me some examples to make it concrete.
Bitcoin, network token, not an ancillary asset. Satoshi disappeared. There's no originator anymore. Value comes purely from network operation. Ethereum, network token, marginally still an ancillary asset. The Ethereum Foundation still exists, but it's close to sufficiently decentralized. A token with dividend rights, out, not a network token, can only be classified as a security.
So why does Clarity split these into 2 judgments? Why not just bundle them into one test?
Because they trigger completely different legal consequences. Whether it's a network token determines whether the secondary market is subject to securities law. Whether it's an ancillary asset determines whether the originator must continue making disclosures to the SEC. This is the biggest structural difference between Clarity and the Howey test. Howey bundles every question into a single test. Clarity splits them into independent judgments. Hold this framework in mind. Back to Hyperliquid.
So is Hype a network token?
Let's run through the negative list: equity, debt, liquidation distribution, dividends, profit sharing. Hype has one borderline issue here: its protocol fee buyback and burn mechanism.
Isn't buyback and burn just a disguised dividend? Doesn't that hit the dividend right prong?
That's where it gets interesting. The economic effect looks like dividends, but legally, it isn't a dividend. Mechanism breakdown: the trading fees, liquidation fees, and insurance fund earnings collected by Hyperliquid are largely used to buy back Hype on the open market and burn it. It doesn't pay holders cash directly. Instead, by reducing circulating supply, it indirectly increases the value of each remaining Hype. The Act, in the Network Token Characteristics section, explicitly carves out an exception: mechanisms of the distributed ledger system collecting, receiving, accruing, or distributing consideration from the functioning of the distributed ledger system. This kind of value mechanism does not count as a financial right. Hype's buyback and burn runs automatically through on-chain protocol logic, fitting this carve-out neatly.
Is there a counter-argument?
Yes, burning is essentially indirect profit distribution, and the burn cadence is partially team-controlled, which revenue streams flow into the buyback and how much the team can tune. So, this is a borderline case, and the final answer depends on SEC rulemaking down the road. Let's assume Hype passes. It meets the definition of a network token.
Is Hype an ancillary asset?
Does its value depend on the Hyperliquid Labs team? Obviously, yes. The team is still driving development, the product roadmap is still advancing, marketing continues. Ancillary asset? No question. So Hype is simultaneously a network token plus ancillary asset. Both.
What does that mean?
Two legal consequences. First, Hype's secondary market trading is not a securities transaction. The network token provision of the Act directly clears it. Second, Hyperliquid Labs still has to submit disclosures to the SEC every 6 months. Business progress, token distribution, risk factors, financial statements, the full package.
Wait, if it's not a security, why does it still need to disclose to the SEC? Isn't that contradictory?
That's precisely the most elegant piece of legal engineering in the Clarity Act. The Act uses a specific term, furnish, rather than file. These two words have a sharp distinction under U.S. securities law. Filing triggers the full force of securities law liability, including strict liability. Furnishing does not. The Act explicitly states these disclosures shall not be deemed registration statements. So the precise statement is, the secondary market for ancillary assets is not a securities market, but issuers still bear a reduced-tier transparency obligation. This is Congress's compromise between freeing up the secondary market and protecting investors. The market is unshackled, but issuers stay transparent.
Here's a sharp question. Didn't the SEC already issue a March statement classifying Ethereum, Solana, and others as digital commodities? So what does Clarity actually add beyond what the SEC already gave?
Critical question. The difference is subtle, but extremely important. The SEC's March statement acknowledged tokens themselves aren't securities, but said an investment contract may attach to a token. As long as the originator continues making essential managerial efforts, that investment contract persists, and secondary market transactions could still be classified as securities transactions. Clarity directly severs that chain. As long as the token doesn't carry financial rights, even if the originator is still making essential managerial efforts, secondary market trades are categorically not securities transactions, and the SEC statement is merely an administrative interpretation. The next chair can reverse it. Once Clarity becomes law, it's irreversible. That's the real release valve Clarity provides.
Token layer done. Let's go to the system layer. First, a question on something I've heard. Isn't Hyperliquid like dYdX or AEVO? Off-chain matching, only settlement on-chain?
Wrong. That's a very common technical misconception. Hyperliquid does fully on-chain matching.
On-chain matching? How does the performance hold up?
They built their own L1. This chain runs two execution environments, one called Hypercore, dedicated to the order book, matching, and liquidations, another called Hyper-EVM, which runs general-purpose EVM smart contracts. Both share a single consensus layer called Hyper-BFT. Here's the key part. Hypercore is not a smart contract deployed on the chain. It is part of the L1 protocol itself. Submitting an order is a blockchain transaction. Matching is produced deterministically as validators execute consensus. Liquidations and forced closes are written into blockchain state. There is no off-chain matching server. There is no hidden order book. This is why I say Hyperliquid is L1, matching engine, and liquidation system fused into one. Physically, code-wise, and organizationally, they are the same thing.
Is this a good or bad thing for Hyperliquid?
Advantageous. Section 301 of the Act requires full execution via on-chain code. And on this prong, Hyperliquid actually scores better than dYdX v3-style off-chain matching dexes.
So where's its actual legal risk?
Right here. The matching rules and liquidation logic run on-chain, but the people who can modify those rules are a small group. We'll expand on this in a moment.
Before we get to the system layer, a fundamental question. Who actually regulates Hype? SEC or CFTC?
Another core line in Clarity that many people miss. Clarity doesn't just define tokens, it also redraws the jurisdictional boundary between the SEC and the CFTC. Digital securities, SEC. Digital commodities, CFTC. Network tokens are a subcategory of digital commodities, so they fall primarily under CFTC jurisdiction. What does the SEC still oversee for Hype? Only two residual things: the reduced-tier ancillary asset disclosure and baseline anti-fraud and anti-manipulation authority. The actual day-to-day regulator for Hype is the CFTC, spot, derivatives, market manipulation oversight, all CFTC.
Is CFTC oversight a good thing for Hyperliquid?
A substantive positive. The CFTC has historically been far more crypto-friendly than the SEC, treating Bitcoin and Ethereum as commodities for years, allowing futures and ETFs. Landing inside the CFTC framework gives a far more realistic compliance path than the SEC framework. This thread comes back when we discuss registration requirements.
Now finally, the system layer. How does the Act view the Hyperliquid system?
The Act examines the same system from two different angles, triggering two different legal consequences. First angle, Section 104, Coordinated Control.
What does coordinated control mean?
The Act says a distributed ledger system is under coordinated control if any person or group of persons under common control has the authority, through any means, to control or materially alter the functionality, operation, or rules of consensus of the system. In plain English, is the fate of the system still in the hands of a small group of people? The Act sets 5 tests. The fewer you hit, the closer you are to not under coordinated control, the freer you are. Let's run Hyperliquid through them.
Go.
First, openness. Is the protocol publicly available? Yes. Passes. Second, permissionless participation. Can anyone run a node and participate in consensus? No. Hyperliquid L1's validator set is restricted, publicly reported as roughly 16 validators. Joining requires team approval. Hit. Third, distribution. Does any single party hold more than 49% of tokens or voting power? Based on public allocation data, the team plus early investors combined most likely exceed this threshold. Hit. Fourth, autonomy. Can the system run independently without the team driving it? Currently, it depends on them. Hit. Fifth, economic independence. Can the value accrual mechanism run autonomously? Hyperliquid does well here. The protocol fee buyback runs continuously. Passes. 5 tests. At least 3 hit. Conclusion. Hyperliquid currently has very little chance of obtaining the non-coordinated control certification.
So what does under-coordinated control actually trigger?
Resale restrictions on the originator and large holders. This is the heart of why coordinated control gates unlocking. Clarity worries that, before a project actually decentralizes, founders and VCs leverage their insider advantage, superior information, ability to modify the protocol, ability to influence prices, to dump on retail. Once the project genuinely decentralizes and coordinated control dissolves, these people have no information edge over retail anymore, and the lockup loses its purpose. So coordinated control is essentially asking, does insider advantage still exist?
What are the specific restrictions?
Related persons means founders, the Hyperliquid Labs team, top 10% holders, and team members holding 4% or more. Before certification, coordinated control still in place. Must hold for at least 12 months before any sales, and can only sell a limited percentage per 12-month period, as defined by future SEC rules. After certification, restrictions loosen, 6-month holding period, but still no more than 10% of circulating supply per 12 months.
And if they violate the rules and quietly sell anyway?
The Act states, profits from violations belong to token holders. Any token holder can sue to recover them. Holders of 5% or more, if the originator fails to act within 60 days, can sue on the originator's behalf. Statute of limitations, 2 years.
That's harsh.
This is one of the most direct positives the Act brings to the market. It gives the altcoin market's biggest fear, VC unlock dumping, a legal framework. And it's why Hyperliquid jumped 11% on May 14th. The market saw 2 things. Token secondary market freed, plus VCs can't dump short-term.
And the second angle?
The second angle, Section 301. Note, Section 104 and Section 301 examine the same object, but from different angles, triggering different consequences. Section 104 asks, does insider advantage still exist? And triggers resale restrictions. Section 301 asks, is the system decentralized enough? And triggers registration requirements.
How does Section 301 judge?
Section 301 introduces a concept called non-decentralized finance trading protocol. A DeFi trading protocol is classified as non-decentralized if it meets any one of the following. 1. Some person can unilaterally control or materially alter the protocol. 2. The protocol doesn't operate purely through on-chain code execution. 3. Some person can unilaterally censor user access.
How does Hyperliquid match up?
Going through each. Second prong, full execution via on-chain code. Hyperliquid passes this. As discussed, Hypercore's matching, liquidation, and forced close logic all execute at the consensus layer. No off-chain components. More thorough than dYdX v3-style off-chain matching dexes. Third prong, unilateral user censorship. No public evidence that Hyperliquid actively censors specific addresses, so passes for now. First prong, unilateral control or material alteration. This is Hyperliquid's actual legal risk. The matching code runs on-chain, but the people who can change that code are a small group. Validator set is about 16. New entries require team approval. Protocol upgrade authority is held by Hyperliquid Labs. The HLP insurance fund parameters, liquidation rules, and fee structure can all be modified via protocol upgrade. This is the real trigger. Not matching isn't on-chain, but the right to change the matching rules sits with a small group.
What happens once it's classified as non-decentralized?
The Act requires the operator to register, which raises the critical question, register as what? With whom? This is where the CFTC thread comes back. If what's traded on Hyperliquid are network tokens and digital commodities, then it's primarily dealing with the CFTC and can register as a digital commodity exchange or a digital commodity broker-dealer. The CFTC already has mature crypto frameworks. This path is painful, but viable. But if Hyperliquid ever lists products involving securities, say an ancillary asset or a genuine security token, it simultaneously falls under SEC jurisdiction and must register as a broker-dealer or exchange under securities law. The SEC registration path is the real dead end. The SEC has never approved any crypto exchange to register as a national securities exchange. Not a single one.
So how many real paths does Hyperliquid have?
Not multiple choice. It's a three-way decision. Path 1. Genuine decentralization. Open the validator set. Hand protocol upgrade authority to a DAO. Lock the insurance fund parameters and liquidation rules. Satisfy the Act's decentralization definition and bypass Section 301 registration entirely. But this means the team gives up control of the protocol. Path 2. Register under the CFTC framework, strictly limited to digital commodities. Viable, but it locks Hyperliquid out of any product line involving securities. Business scope is sealed. Path 3. Geographic exit. Block U.S. users. Move the entity offshore. Serve non-U.S. users only. That's what Binance and Bybit chose. No middle ground. That's precisely Section 301's legislative intent. Force projects to either truly decentralize, fit into a clear regulatory regime, or leave the U.S.
So overall, is clarity a net positive or net negative for Hyperliquid?
It's a multi-layered judgment problem. You can't read just one layer. Token layer, clarity, friendly. Hype's secondary market freed, primarily under CFTC oversight. Short-term positive. System layer, Section 104 angle. Coordinated control restricts VC and founder sales. Short-term positive. System layer, Section 301 angle. Protocol upgrade authority is centralized, triggering registration requirements, either decentralize, register with CFTC, or leave the U.S. medium-term negative. Hyperliquid rallied 11% on the day. The market may have seen only the first two, but read the full act and you'll find Section 301 is the real core tension. The token side and the resale side are cleared, but the fate of the protocol itself remains unresolved. The team must either voluntarily relinquish control, accept heavy regulation, or abandon the U.S. market.
When does the act actually take effect?
May 14th was only a Senate Banking Committee approval. The bill still has to clear the full Senate, reconcile with the House version, and get the president's signature. Optimistic timeline, mid to late 2026. After that, SEC and CFTC need another 360 days of rulemaking.
So what does Hyperliquid do in this 12 to 18-month window?
Several critical decisions. 1. whether to relinquish protocol upgrade authority to a DAO. This is the core question for the Section 301 path. 2. Whether to restructure Hype's buyback mechanism to avoid any design that could be read as disguised dividends. 3. Proactively disclose related person lockup schedules. The non-coordinated control certification application should be prepped early.
Final word?
The Clarity Act doesn't liberate crypto. It creates a new compliance framework. Structurally clean projects, Bitcoin, Ethereum, Solana, are the winners. Semi-centralized gray zone projects actually face sharper compliance pressure. Hyperliquid rallied 11% on the day, but this act is a multi-layered judgment problem for it. Token layer freed, resale side framed, protocol layer pressured. 3 layers, 3 directions, and you can't read just one of them.
See you next video.